Hey everybody, welcome to the Tuohey Talk Show. Today, we're going to talk about inflation and the Fed raising rates. Let's get right on into it. Transition. Ooh. All right, everybody. So I actually don't have a guest today. It's going to be just me. Kind of like every other week, it seems like. We're just going to do just me, and we'll see what you guys like more. If you guys like hearing my beautiful, sexy voice and this voluptuous hair. No, but we'll start off with ooh, oh my goodness, guys, I was actually trying to get a guest on today. I was gonna say that's really ironic timing right as I started it. But today I'm filming on Wednesday. I have to go back to New York tomorrow morning, so I won't be here on Friday to film. So we're doing it early, and that's convenient, guys. Is tomorrow St. Patty's Day? Yeah. So it's kind of like perfect timing, which is why we didn't even allow you guys to vote for the drink. I didn't care because I wanted to do something Irish. It's like the drink of my people. I am like 100% Irish, if you didn't know. That's why I am really pale and can't tan. But that's also why I love me some. Wait, what do I need to pour the Baileys in, right? A true Irishman would know that. No, we just know how to make really good potatoes. We're gonna do what? In the shot glass. Yeah, in the shot glass. Oh yeah, don't worry. I'm not. This isn't my first rodeo. In fact, I went to my first rodeo this week, and it was. Well, now I can officially say this isn't my first rodeo, but it was pretty crazy. I highly recommend it if you're ever in Texas to go to a rodeo. I now feel like I've truly crossed that line into a real Texan. All right, how much should I pour? Do you think? Like the whole thing? All right, so we pour this into here. Got some Jameson in here already. All right, guys, here you go. No. All right, we also have you guys know my crew is always joining in on the drink choices with me. So here we go. We drop this into the cup. 3, 2, 1. Oh, that's just good. That's like 3 different types of liquor in one drink, isn't it? It's beer, you got beer, Guinness, Jameson, and Bailey's. If you guys don't know how to make an Irish car bomb, I just taught you. So what you do is you pour the Guinness into the cup, and then you get a shot glass, and you pour like half Jameson and half Bailey's. But apparently, do not mix the Jameson and the Bailey's ahead of time. Behind the scenes here, we got going on a little too much, drank too fast and got stuck in the throat there. So, but no, it's a fun, it's called the Irish Car Bomb. Perfect for St. Patty's Day for those of you guys who are going to be celebrating. Highly recommend trying it out. You can look it up online. But again, half the shot with Jameson, half the shot with Bailey's, and you drop that shot glass into a glass of Guinness, and then you drink it very fast because it will curdle if you let it sit too long. There's your lesson of the day. Now, as I mentioned this in this intro, today we're going to be talking about essentially inflation and the recent rate hike that the Fed just announced today. There was the FOMC meeting, and we've been anticipating rates to be hiked, right? Like this isn't new news. In fact, we've been waiting for it for a while now that inflation is pushing 8% at the end of February 2022, which is it's a drastic increase in a very short period of time. In fact, so much so, let me get my notes up here. We're going to be talking about a lot of numbers today. So I decided to take some meaningful notes here just because I don't remember all these numbers off the top of my head, if I'm being completely honest, but they are really important to not only, very important to especially the overall market, but your daily lives, right? This is stuff that truly, and as we've seen with the oil and gas prices, as we've seen with, I don't know about you guys, but I go to the grocery store now and I'm still spending noticeably more money than I used to. Now, I also eat a lot of food, so it's a very drastic price increase, right? When I'm paying for meat and whatnot. But this is all, and there's plenty of reasons aside from just inflation. A lot of this global conflict we're going through is going to lead to likely more supply chain issues. Anyways, this is among the highest level of inflation in quite some time. The last real massive spike we had over In fact, the last time we were over 5% was in 1990. And we're gonna have some graphs show up on the screen here as I'm looking at them. So, but no, the 80s were essentially among some of the highest inflation we've seen this century, only topped by the late 1940s, where we got up to 15% inflation. However, in the 90s or 80s, in the early 80s, we got up to just about 15%, which led to some very, very massive rate hikes. Am I saying rate hikes? Yeah, it sounds weird. I feel like I'm saying it backwards, but I'm not. Rate hikes. And essentially, again, we can never predict the future here. We cannot predict. They can tell us how much they're going to keep hiking up the rates, but they also expected that inflation was going to be at 2% this year, and we're now at nearly 8%. So as much as we want to predict and keep those numbers low, we have to kind of be prepared for everything. And I want to talk to you guys about what this really means in terms of our daily lives and in terms of the market. What happens to the markets during these times of massive periods of inflation when interest rates are raised? So right now we're sitting at roughly, again, we increased as of today, 0.25%, 0.25%, which is, quote unquote modest, considering, right, that, let's see, we're going to pull up this chart here too. In the 80s, in the early 80s, when we were going through that massive period of inflation, rates were raised to nearly 20%. And for reference, right now, we were at 0% for 2 years, right? 0.09%, minuscule. And so again, we'll get into all this and what it really means. But I mean, for those of you guys who are, maybe either trying to get loans, mortgages, whatever, back in the 80s, you'll remember that this was an almost unaffordable. I say you'll remember like I was part of it. I wasn't even born then. I wasn't even probably thought of then, if I'm being completely honest. Was I? Let's see. I was born in 98, 18 years. No, I don't even know if my parents weren't married then. They might not have even known each other. Man, I wasn't even, not only was I not a thought, my parents weren't even married then. That's crazy. But I remember like my grandparents telling me about how the essentially affordability of a mortgage has drastically changed over the course of their lives, because they went through that period, right, where interest rates were just so high. Now that was good signs for like a savings account, right, where it was actually made sense to have money in a savings account then, because you're generally getting decent interest rates. You were year over year, when interest rates are raised, you are seeing that effect in your bank account. Now, 0.25% increase, you're not going to see much. Like, congrats, you're going to make an extra 0.25% on your money year over year, when the market itself generally returns you about the overall market year over year for the course of the market's history, around 8% a year. Now, in 2020 to 2022, we saw a market increase from low to high of roughly 100%, which is why, everyone is kind of waiting for these pullbacks, because what goes up must come down. Now, that's not saying we're going to go through a wild market crash. We might just go into an actual true bear market. And that's something I think is important to note too, right? Is that a lot of people are worried about the next crash. During the COVID crash, that was one of the largest crashes that is the largest market crash I've ever seen. Now, of course, during like 2008, there was a pretty drastic decrease, right? I think the market fell, I want to say 50 or 60% during that 2008 recession, but I wouldn't call that a crash, right? The COVID crash really only lasted about a month or two before beginning to rebound, whereas that 2008 into 2009 recession took years to build out of. And that crash even still was roughly a year long. And so when I think of a crash, this is something I think is really important. And this is a point I saw on Twitter a long time ago. A crash implies true panic, max panic. Think of it like a panic dip buy on an OTC stock, right? Where when you get that massive, very fast, very drastic price imbalance, supply and demand imbalance, again, it's an imbalance. It will balance itself back out just as quickly as it came down. Now, maybe not all the way back to highs, but if you get a 50 or 60% crash in a matter of minutes on a stock, that will, at some point, that panic deteriorates, and we get those people who are starting to buy just because of the price indifference, very similar, or imbalance, very similar to what happened during the COVID crash. And that actually ended up likely being some sort of a short trap, right? Where normally those bounces lead to a lower high. Such a sharp drop generally is a bearish sign nonetheless. And there is opportunity on the long side trying to bounce it. However, again, think of it even like a small cap stock, right? When you get a massive drop, it will bounce, but it likely isn't going to break out again like the overall market did. And when that happens, you're going to have big money funds that are loaded in puts, that are loaded short into the bounce, that are eventually getting squeezed out, and which led to that 100% run from lows to highs. And I don't even completely know where I was going with that, talking about savings accounts. Couldn't tell you how I got into that topic, but more or less what I'm trying to get at here is that if we do have an actual pullback in this market, I don't expect it to be in the form of a true panic crash. I expect it to be in more of a gradual downfall. And we're kind of seeing that pattern right now already, right from highs a couple months ago on the SPY. It wasn't some massive 3, 4, 5 day. This has been, how far are we off highs now? How many months? I think it's probably early February. I want to say we hit highs. It's a month now. And we are down, 15, 20%. But it was very much more gradual where we are getting these bounces, right? We're essentially getting that dip, lower high, dip, lower high, dip, lower high, lower high. And so that's kind of more or less what I expect this to be. Even when major support levels are broken, I don't think we're going to be seeing like massive 7 or 8% drops in a day, unless, again, there is so much we've talked about the past 3 episodes. The Russia-Ukraine conflict topic has come up. If that continues to get worse, perhaps. But even during, I think we talked to last episode. Maybe we didn't. This is something I did want to talk about, though, is that during the different world wars that we've had, actually, the market surprisingly didn't have that massive drop during the war because the market had already dropped before that, right? World War II came after the Great Depression, right? Am I right on that? When did World War II happen? Maybe I'm completely talking bogus. I should know this. This is pretty sad. Let's see. We're going to do some quick research here. When did World War September 1st, 1939, right? Okay, so that panic was at the end of the 1920s, right? That Great Depression into the 1930s. And by the time World War II had started, and again, we didn't immediately go into World War II here, right? It took us some time to get into it. And I say us as the United States, literally us. US. No, it took some time. And by the time we had entered the World War, what I guess early 40s, we had already gone through that massive depression. And so us entering the war starting in a sense was already priced into the market. And now we are at highs, we are in a global conflict, but we're not directly involved in this Russia-Ukraine conflict. If we went into a third world war, maybe different story, right? Where the US goes to war with Russia or China, could be a different story. But as of now, that isn't the case. And so when these global conflicts, yes, they do affect the market, but statistically over time, actually during the war itself, the market hasn't had these massive fluctuations. Generally, it's almost been priced into before that, even smaller wars like the Korean War. What was the other one? The Vietnam War. That was one of them, right? Wow. As you can tell, I dropped out of school, did not pass history, didn't pass math, didn't pass science. Okay, I passed history, but I didn't pass science or math. Actually, I just didn't take science. That's why I dropped out. It's because I didn't want to go through chemistry and bio. Come on. You got to give me what they're looking at me back here like I'm completely stupid, which, listen, I'm kidding, off topic. But no, during these wars, right, we do have a drop in the market. It's just simply not an actual crash. What has led to crashes statistically has been things like COVID, things like an actual, the housing market bubble burst, the dot-com bubble burst, right? It wasn't wars, because generally spending actually increases during wars, during times of conflict. And when spending increases, the economy gets stronger. Now, that's an argument in itself where, so I think there's a lot of people that would argue a lot of times wars are started for financial reasons, which is kind of sad, right, to think about. However, it's just kind of the fact of the matter is that wars do help economies. And debatably why we stayed in Afghanistan so long is that it let, and I think Bohen might have talked about this last week, right? Where, why did we stay in the war so long? Well, unfortunately, it led to a lot of government contractors, defense contractors, getting a lot of government money. And again, that provides a lot of jobs, that provides a lot of opportunity. It forces us to spend money as a government. Now, again, we're just got a little sidetracked there, but it is good to understand how this stuff affects the market. And now that we are raising rates, even though it is during a time of conflict, I think that the conflict itself is not going to be or lead to a massive crash. However, during times of raising rates, right, things like, well, just about everything in your life is going to get more expensive. And I earlier was talking about how mortgages were nearly unaffordable. In fact, when I was doing some research for this show, there was actually an article talking about just how unaffordable mortgages were. I think that might have been like the headline, how it was more flashy than what I'm about to say, but the unaffordable mortgages of the 1980s. And this is a great time where, again, it makes more sense to save money than it does invest because of the rates. And that's kind of right, the two different sides of this, where when rates are raised, investing growth is a lot more limited, but saving money is a lot more lucrative. And that is, the age-old advice your parents probably gave you: save your money, save your money, save your money. And then people are always telling you, no, invest your money, invest your money, invest your money. And it's like, okay, well, which one do I do? Investing might not be practical for someone who did not have a lot of money beforehand, because again, you're probably better off saving up to invest if you don't have enough money to really capitalize on those growth periods. However, when growth periods slow and saving periods take over, essentially money is priced at time, more or less, is priced at a premium, where the value of money, of the dollar in your pocket today, is worth more than a dollar in your pocket tomorrow. And that is very, very true during periods of high interest rates. And inversely, that is not necessarily the case during periods of very low interest rates, high growth. No wonder we saw so many overvaluated companies. Interest rates were at all-time lows. Everyone was all-time lows. I say that like, let's see, where are we? Where is this chart I was just looking at? Okay. Oh, I actually just had it up. From about 2009, ironically, at the end of that recession, interest rates are dropped to encourage economic growth. Pardon me. And then from about mid to end of 2015 up until 2019, rates were slowly raised up to about 2%. And that was roughly a 4-year period. We are projected, well, this is what I wanted to talk about too. So with that 0.25% increase in that rate hike plan, during the next 6 FOMC meetings, they plan on raising rates at a set quarter percentage every meeting, which should lead to an effective interest rate by the end of 2022 to 1.9%, which will essentially get us back to levels from 2019. It almost seems like that's what they're trying to do, right? Is get us back to that level from 2019 pre-COVID crash. They're almost trying to correct it themselves. Now, that being said, the difference is we weren't going through massive periods of inflation during 2015 to 2019. In fact, we were at a very healthy, I would argue, a very healthy economy. They were just, again, stable growth. We didn't have any massive inflation, didn't have any massive economic worries. And so it was a little bit more of a healthy interest rate increase, gradual, right? This is going to be a lot less gradual, a lot more sudden, and it's a way to fight that inflation, which is what was done in the 80s when interest rates made their way up to, interest rates made their way up to 18.75%. Inflation was at 15%. Again, we're still at half of that level. And fortunately, the interest rates have not raised to half of our, I guess if you did the math at what they should be, from the 80s to now, when inflation was at 15%, rates were at 18.75%. So interest was actually the interest rates had overtaken inflation. If we were to go there in this short of a period of time, which could happen in the next 2 or 3 years, if inflation remains high, we could see interest rates up over 5%, up over maybe 10%, depending on how this works. Now, what's really interesting as well about inflation and interest rates raising is that it's not necessarily, right? Like the inflation isn't uniform, right? It's not that every single sector will see inflation rates at that level. However, just as we've seen now, right? Oil and gas prices are up. Oh, what is it? It's very broad range here between 50 and 100% year over year. I want to say it's actually like right around 50 right now, year over year. But I can just tell you from when I moved to Texas last year, almost, what day is today? Oh my God, hey, happy anniversary. I moved to Texas a year ago today. Yep. When I moved to Texas, gas was about $2.25, $2.30 a gallon. We are now, I can't go anywhere. What do you guys see, about $4 a gallon right now? $3.99 seems to be the standard level at every gas station. So yeah, right around 40, pushing 50%, between 40 and 50% right here in Texas from what I see. But I know that isn't necessarily the case everywhere in the country. So, yeah, we're at a 7.9% inflation rate. That doesn't mean everything is affected accordingly. And again, that's because there are other factors like this Russia-Ukraine war, which is creating more of a psychological dependency on oil and gas, that even though supply hasn't necessarily massively decreased at, a 40% or whatever that math would be. Again, didn't pass my statistics 2 class. It's not uniform. For example, here are a couple notes that I took right now. Some of the more fitting ones to that inflation number: clothing prices are up 6.6%. Auto body repairs, motor repairs are up 6.3%. Airline fees are up 12.7%, call it 13%. And then rent. Well, so this is the statistic. I guess I also do live in Austin, which is, a booming city. And my rent's increasing more than this number, but rent/shelter is up 4.8% year over year. Now, my rent, apparently they want to charge me an extra 15 to 20% this time around, for the longest lease. I know a lot of apartments here in Austin, especially downtown, that were raising their rent prices 30% from last year. That's crazy. Now, what's interesting though is that housing prices, and I think everywhere. Now I'm from upstate New York, so I still like to kind of keep in touch with those rent prices. Again, it's pretty easy. I've got family there. Housing prices didn't drastically increase. They definitely rose, 20, 25%, which is a drastic increase in such a short period of time. But here in Austin, oh man, I don't know the exact data, but I know at one point, now this was during that peak craziness, there were houses that were up over 100% year over year in terms of value. And again, that's because not only were we going through all of that housing bubble, right? We want to call it bubble, but Austin is also, everyone is moving here, lower really no taxes, I guess in Texas, no state taxes for income. And you basically had a lot of people from places that were already overvalued finding an area that was undervalued and being able to pay cash for these houses. And they didn't care if they paid over. There are a lot of really beautiful houses here. It's a great area. And so different areas are going to be affected differently. But again, the number is apparently 4.8%. I would argue that in some bigger cities, it's a lot higher. But again, the whole point of that is that, as you see, these are slightly different numbers. Now, apparently airline fees are up out of those that I listed the most, which doesn't surprise me either. I told you I'm flying back home to New York tomorrow. And oh my gosh, the ticket prices are absurd. I remember I used to be able to go home. Now again, this is going to sound so bad, but I'm too tall to fit in the seats. So I have to fly first class or buy 2 seat tickets because my legs are too, I'm all legs, right? You see me sitting down and you're like, okay, you're not that tall, but I wear a medium size length torso, extra large sleeves. And then my pants are just outrageously, they're bad. For those of you men watching and know men's pant sizes, I wear like a 34, 38. It's brutal. Yeah. It sucks. And fortunately, I actually used to be a 32, 38. That was even harder to find. It depends on I guess it depends on the brand too. You guys all know, right? Different like clothing brands. Sometimes like a 30, I can fit into some 36s and the other ones, most of them are 38s, but I can't find those in stores. I can promise you that. And I cannot find long sleeve shirts in stores either. Because again, let me reiterate that a medium length torso with extra long sleeves. And unfortunately, right, the hardest part, we're going into a little tangent here, but I know some of you guys, clothing is tough, right? Like for me, everyone's like, oh, shop at a big and tall store, but I'm like tall and way too thin. It's so hard. I'm trying to put on weight so bad, but it's just not working. Unfortunately, I need to find a way to slow down my metabolism a little bit, because it's just like, I need to be able to fit into some clothes. Like I can't go get anything. So I would argue that probably clothing is up more than 6.6% for me. Inflation is really going to be making me feel this one. We got a little sidetracked there though. So I kind of want to give my thoughts as to whether or not this could get worse, right? And going back to that point, as a way to counter inflation during the 80s, right? Interest rates did raise to nearly 20%, but how fast was that and how long did it last for? Well, if we go on these charts, we'll put them back up on the screen here. We'll start off here with the federal funds effective rate from about, I'm going to take a guess here because I can't see the exact dates, but from about 1981 to 1982, within a year, they rose from 9%. So they were already high because, again, inflation was rising. So it's not an overnight change. These changes are not overnight. A year or two is a likely implementation period. So from like 1981 to 1982-ish, we got that spike from about 9% up to about 19%, and then gradually fell, it double topped, quote unquote, at around 18.75% in what looks to be mid 1982. And then by 1985, interest rates were down at 12%. And then by 1990, interest rates were down at 10%. And it wasn't until the mid 90s where interest rates were down under 4%. So as you see, that was like a 15-year period from highs to quote unquote lows. Now, it did have some more lows, like let's say 1986, 1987, as you can see on this chart, we hit a low there of roughly 6% from 19%. Now, let's look at inflation next, right? You know, how did that change? Now, inflation during the 1980s made its way up, as I said, up to about 15%. By the mid 80s, inflation had fallen back down to 3%. So that drastic increase in interest rate did lead to a fast or quick, you know, whatever you want to call it, decline in the inflation. But they can't just immediately reverse those changes, or else there is risk that inflation rises back up just as fast. So they have to gradually cut down on those interest rates. And again, it's very likely, right? We've been at an all-time low interest rate. Again, all-time low as in zero, more or less. I think it actually might have literally hit zero now. They say 0.09%, but call it zero from 2020. For 2 years, there's been no interest. And that is just simply not sustainable. And it wouldn't surprise me to see interest in the next few years up 4, 5, 6%, where it is almost smarter, right, to put your money into a savings account than it is the overall market. This is where we're going to see growth periods slow down, and you need to do that in order to fight inflation. When we grow too fast, and this is just simple economics, which I did pass, boom, simple economics is that when you grow too fast, everything else around you is going to grow too fast, aka inflation. Now, we can blame this on politics, you can blame it on wherever you want. It really just boils down to like very simple math, is that when everyone is making more money, and that's why you're seeing a lot of very unsustainably high wages right now in a market where not only do people not want to work, but we're also growing. The economy, you know, financially is growing. It's such a fast rate. Companies are paying a lot. I know one of my buddies, not even buddies, I met him at my apartment complex, and I'll do a little quick side story here. So he was driving this, there's a blue Lamborghini Huracan parked up at the top of my parking garage on the weekends. And my brother flew into town last summer, and I was like, hey, we should go check and see if that Lambo's here. And we drove up, and it was there. And the owner of that Lamborghini was actually sitting there, and he's like, hey, do you want to sit in it? And I was like, oh my God, that'd be kind of cool. I didn't fit in it, unfortunately, probably for the best, because I would have blown like all my money on one. It looked so cool. But so I got talking to him. I was like, hey, out of curiosity, man, like what do you do? Like, I'm just curious, you know? And he was telling me he is a artificial intelligence developer for like a small startup. But again, a small startup. I'm like, what? And he's like, you know, I make about $450,000 a year. And I was like, wow, for a small startup, that's pretty good. But then I talked to a lot of other people here who work for Facebook, who work for, well, maybe not Facebook anymore. Now they're down 50% from highs, but, you know, Google, Apple. And a lot of these developers, these software roles are getting paid multiple hundreds of thousands of dollars a year. And it's just because it is a high skilled job in a booming city. And again, it's a fact that they grew a lot as well. I mean, these are legitimate companies, right? I mean, we see small caps every day that run 50, 100, 200% in a day, but they all fall down. They don't actually make money. These companies are pump and dumps at the end of the day. These were real companies, I say multi-billions, but hundreds of billions, if not trillion-dollar companies that grew 100% by stock price over the course of 2 years, if not more. They're going to have more money to pay high-skilled people. And again, in a job market where not a lot of people want to work because of all this COVID stimulus that we got, when the supply is low, the supply of workers is low, companies are going to pay people highly skilled employees more money. And so it's just, and when people are paid more money, and now we're almost going back to the housing thing. People are able to, they don't care. They don't care about money. They've never had this. They've never had all of this money at once. And they're like, oh, whatever. Like I can afford that. And now to be fair, the guy with the Lamborghini, he had actually a really kind of sad story. He told me he had some really, really bad personal, I won't get into it, but he had a really sad personal story. And he's like, life is just too short not to, life is too short not to get what you want. He's like, I've always, like, since I was young, every time I just thought of myself driving a Lamborghini and I always wanted it. And now that's, that I think that's an exception, because a lot of people who buy these like really fancy cars are like, it's an impulse buy. It's like they got a lot of money and they're like, oh, that'd be cool. And then within like 2 months, like, okay, it's just a car. This guy's, he said he's had the car for a little over a year now. And he's like, every day, I love it. And it's just like, it reminds me of, helps me get through that time. So different story. I respected his story a lot, but the story was really as a way to show that why inflation happens during periods of growth. And then when we grow too much, unfortunately, for the most part, I gave you some anomaly examples, but the majority of working class wages are not rising with inflation. I'm sure. My parents, I talk to people back home. I talk to a lot of people here, and if they get a salary, a promotion, if they get a promotion, it normally is not reflective of inflation rates, right? Like we're at 7.9% right now, which is up 6%. I know a lot of people who are still getting paid probably the same prices they were during 2020 or slightly higher, but as inflation continues to get higher, again, we went back in the 80s, 15% just about. And even, during the 90s, inflation was at 5%. And during those times, it's simply most working class people are not going to be getting, their wages are not going to be reflective of inflation, especially when you have a lot of very, needs, right? Oil and gas, you're probably going to need to drive. Food, I would imagine you have to eat. Although, I know a lot of people who do not a lot. I know some people who do like a 30-day water fast. Congrats to you, because I can't go 30 minutes without eating. But, these are things that you need. Rent, right? Rent, I can tell you here has increased probably 20%, 30%. And in these areas, wages, generally speaking, for the average are not increasing at that rate. So you have to counter it by raising interest rates and, incentivizing saving over investing. And that's what's going to lead to a lot slower growth and more stability. And hopefully we can fight that. It's always a situation where you need to balance things out in the economy, because you cannot, I'm sure you've all seen the graph. I don't have it pulled up, but it's essentially the cycles, right? When you get to highs, growth was at an all-time high, and then you have to bring it back down. You have to slow down the growth and almost reverse growth. And that's obviously not truly reversed, because if we look at the S&P 500, we see that it's, consistently grown decade over decade, but you have to slow it down in order to make sure we don't go into some period of hyperinflation where that's when and I would argue we already have a pretty wild wealth gap, but you have to try to slow that down. And that's generally the way you do it, is kind of by slowing it back down. And there's probably a lot of arguments that still, we've been seeing a diminishing middle class for the past 30 years, right? This isn't brand new, but the extent of which that gap has increased during COVID and during this period of massive growth truly is astonishing. And the only way to really bring that back down is to try to almost like recreate a middle class by distributing the wealth a little bit better. And unfortunately, there is no perfect utopian style answer, but we can do our best by raising interest rates. So anyways, this is like been a pretty lengthy talk here about inflation. How long has this been? Too long? Are we good to, do you think I'm good to start wrapping it up here? Yeah. Okay. I'm going to start wrapping it up here, but I want to make sure I didn't miss anything on my notepad here. Let's see. And I guess the way I'll end on this here is that kind of reiterating that while, you know, everyone, I think the market is kind of already priced in the raising interest rates that we're seeing now, right? Essentially getting up to 2% by the end of this year. But at the end of the day, 2% isn't that high historically. And I think it's very likely that in the next few years, especially with so much global uncertainty, not only in the geopolitical space, but in the economical space, I don't think it's unrealistic that this is the highest we're going to go. I would not be shocked to see interest rates continue to rise throughout the next few years as a way to really make sure we're fighting inflation. We printed a lot of money, and I mean trillions of dollars, in order to reverse that. And that's essentially raising interest rates is almost the government's way of taking back the money that they printed, or at least making, well, yeah, more or less taking it back. That's what printing is all about, right? Is that you're giving more money. At some point, they need to take it back. Like, okay, we gave a lot of money. We need this money back. And you know, that's why this is being done, because we gave out so much money. But again, think of how much money we printed. I want to say it was around $6 trillion. Could be wrong. That could be way off. How much money did the US print? States. COVID. Let's see. Oh, that wasn't that far off. 5.2 trillion as of March 2021. And so they need a way to kind of get that money back. And in my opinion, they will not be able to do that at only a 2% interest rate. And everyone understands that. But after being at nearly 0% for so long, 2% within a year seems pretty high. And yeah, it's a pretty drastic increase. I'd argue 0.09% to nearly 2% within a year in terms of percentages. That's pretty high, right? I mean, 100% increase in interest rates would be 0.18%. And clearly, so I guess it'd be 1,000% increase. Yeah, that sounds about right. It's probably going to keep going higher. And again, I'm no expert. I'm not an accredited economist. Although that is, well, no, actually, one of my life goals is actually become an accredited philosopher. Come on, let me know down in the comments below if you think I'd be a great philosopher. I actually have a theory. Oh God, I'm going to just say it, I guess, at this point. I'm already this far in. That's my biggest problem. My friends know it all too well, is that sometimes I just talk and talk and talk, and all of a sudden I say things that, you know, debatably are a little embarrassing, but I'm working on the puzzle theory, right? And I won't get too far into it because I'm going to write an entire thesis about it. It's essentially how different puzzle pieces in your life fit together for some reason, but you'll think that, you know, as you see in a puzzle, a lot of times it's very hard to find the last few puzzle pieces. Maybe not the last few, it gets a little easier then, but you have a lot of the puzzle complete, right? But maybe you still have a lot of people, I'd say, start with the edge. And then as you get in the middle, you'll have a lot of images that are very close together. The pieces look like they should fit, but they don't. And a lot of times you have to like move that puzzle piece around quite a bit to find exactly where it goes. And I'd argue a lot of us as a whole have our lives together for the most part, but there are some little parts missing. And that's the puzzle theory, is working on finding those missing parts. Okay. Anyways, again, not an economist, but it would not surprise me to see this getting worse. It's just a matter of how much worse. And again, it's understanding, and that's why I wanted to talk about this today, the difference between low interest rate growth periods versus high interest rate saving periods. And hopefully you can prepare in a way, right? I don't think we're at a time yet where it's definitely, you know, where it's beneficial to have money in a savings account, but we could get there. And I would argue that probably when it gets closer to 5, 6, 7%, if it gets closer to that, that's when it's going to make the most sense. And hopefully we're not doing a too drastic of an increase. But as you saw in those graphs earlier, I mean, during the 80s, when inflation was at not all-time highs, but pretty close to it from, I shouldn't say all-time highs, because I think it was, when was the other time in the 40s. I'm actually gonna throw up another chart here real quick just to give you an understanding, almost like recap everything. But yeah, at the end of the late 1940s, inflation was at 15% after the war. Wars also, while they do lead to economic growth, again, economic growth means inflation. And that's why actually a lot of times post-war, you go into periods of inflation. But let me throw up the consumer price index here, and you'll see this was a CNBC data point from the Board of Governors Federal Reserve System, U.S. federal funds effective rate, retrieved from Federal Reserve Banks of St. Louis, Bank of St. Louis, not banks. Consumer price index is at a multi-decade high, pushing the only period higher than that was shocking, the 1980s. But it's pretty surprising that the consumer price index is working its way towards, again, I guess that more or less is really just inflation just shown in a different graph here. But it's almost like a breakout chart. And without countering that, I hope you feel the same way. You don't want to go into a period of hyperinflation. I seriously do not want to go into a period of hyperinflation. So raising rates is the best way. We will likely see during in periods of, that was the last thing I wanted to talk about. During periods, so how does this affect the market, right? During end of 2015 to 2019, while we were slowly raising interest rates, we were not dealing with massive inflation. So the market still grinded its way up. We didn't see a bear market during the gradual raising of interest rates, because those interest rates were, one, being raised gradually, and two, not necessarily being raised to fight this massive inflation waning over us. But this time during the raised interest rates, we are battling inflation, and the market knows that, in which that is more likely where it's going to lead to some kind of quote unquote bear market, or at least not, again, periods of growth. So keep that in the back of your mind, people. That's all I want to say. Hopefully it's nothing too drastic. That's all we can do, all we can hope for. With that being said, guys, I'm about to heading on out of here. Before we do head on out of here, I do want to let you know, though, that despite, hopefully not, I should say, a potential incoming, I call it a bear market. Don't let bear market scare you. That doesn't mean crash, but slower growth period. What's beautiful about the small cap space is that there are always opportunities despite the market condition. Again, these are what we call pump and dumps. Now they are going to dump, but they can first get pumped. During these periods, there are still opportunities as a day trader. So don't let this scare you away from, if you're maybe just getting in the market, don't let this scare you. I have data on this. There were still runners during the 2008 recession, 2008 to 2009. There are still opportunities, and that is our goal as day traders. Sure, there might be not as many opportunities as there were during 2020. We probably won't see those types of opportunities again for a decade. But that our goal, our job is, right, to find these opportunities. And that is what my goal is, to help teach you guys how to do. Myself, Matt Monaco, and John Papa, guys, we are all part of Small Cap Rockets. I'm sure you probably know that by now. But we are looking for, and even now today, there are less opportunities than there were just a few months ago. But we're still all of us are still at our all-time highs for our P&Ls. And I'd like to think we're doing a good job at helping traders stay safe and learn almost the emotional side of knowing when to attack the best trades as opposed to just throwing money at anything. And that's a very, very important aspect right now. If you guys are interested in learning the way we trade, even during a slower market period and potentially incoming bear market, knock on wood, hopefully it doesn't happen, be sure to check us out in Small Cap Rockets. We have a link right down below here where you can get in. What is it? Is it 7 or 14 days right now? It's either 7 or 14 days. At least check us out for a week or two, depending on the offer we have currently going on. And I genuinely stand by. I think we do a very, very, very great job at making sure traders are learning the emotional side, the risk level side, the risk management side, as well as learning how to spot the patterns that we trade every single day, despite the changing market conditions. So again, that link will be down in the description below. And that's all I've got for today, guys. So first of all, let me know down in the comments what you think about all this. I'd love to hear your guys' thoughts on inflation and the raising of interest rates. Do you think we could continue to keep raising after 2022? And again, a lot of this will probably be affected by global conflicts, but still let me know down below. And yeah, make sure you leave a like if you like this video. Be sure to subscribe if you're not subscribed. Turn on those post notification bells. I heard it's really fun to click that button and turn it on, but you know, what do I know? Anyways, thank you guys for tuning in. And I will be sure to see you guys back here next week for next week's, is this episode 4? Nice. I'll be sure to see you guys back here for episode 5 next week, where I've got a couple of potential guests lined up. All of them, I think, will be great guests for you guys to listen to. So have a happy, this is coming out on Friday, isn't it? Have a happy Friday. Hope you had a great St. Patrick's Day yesterday, talking in the future right now. And I'll see you guys here next week. So reverse salutations, hello? I think it can also mean goodbye, though. Reverse salutations. We hope you guys enjoyed that last video. Thanks so much for watching and being a part of the StocksTrade community. We wouldn't be here without you guys. Be sure to hit that like button and subscribe to the channel if you haven't already. Our goal is to hit 100,000 subscribers by the end of the year, but we can't do it without your help. So if you enjoy what we're putting out and want to hear more, be sure to hit that subscribe button. I'll see you guys in the next video.